Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our December monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. It was great to see many of you at our curbside event this past Saturday. We had almost 100 cars and gave away, I think, over 160 dozen tamales. It was great to see many of you there, and we thank those that participated and that donated to Cypress Assistance Ministries. Because of your donation, we were able to help hundreds of families this time of year. So it was great to see many of you there. We also want to thank those that nominated family members who have served our country. This coming Saturday, our team will be laying wreaths on behalf of those. We have about 70 nominees from family members of clients, and something that we're honored to do to honor those that served our great country. We also hope to see many of you in the new year. You'll be getting a note about this very soon. Wednesday, January 24th of the new year, we'll be again joining with all of you at Perry's. We expect and hope for a good turnout and look forward to seeing you then. So a lot to cover. We'll jump right in. After a bad August, September, and October, November was a great month for stocks. So you'll see we're ended as of the first week of November. The S&P sits at about 4,600, which is considerably higher than the 3,577 that the S&P was at following kind of the low point of this cycle in October of last year. Still below where we were in early 22, where the S&P was at 4,800. But again, when kind of things were at maximum pessimism at the end of October, the markets had one of the best months in a very long time in the month of November. As we look at equities thus far in 2023, it's really been a tale of the Magnificent Seven, these stocks versus everything else. And interestingly enough, while those Magnificent Seven are still responsible for roughly 70% of the return of the S&P 500 this year, that's actually broadened out from where we were in May of 23, when it accounted for 96% of the performance of the S&P 500. So what that means, the fact that the top 10 stocks, including the Magnificent Seven, have gone up so much, means that on average, they're trading on a forward PE basis of about 29, which is 142% of historical average. The remaining stocks in the S&P, you'll see trading at, closer to average, if not a little bit above. Another thing we're following is the fact that the market cap weight of the top 10 stocks in the S&P 500 are roughly a third, while the contribution of earnings, the S&P 500 is 21. So there's an imbalance there that we're paying close attention to. We also had a great month in November for bonds after a number of months of consecutive declines. You had a top 10 month going back to 1970 for bonds, up 4.5%, with interest rates after peaking coming down somewhat. We have had a lot of bond volatility the last 2 years, with 71 and 62 calendar days in which the bond index was up or down by greater than 0.5% or more. The last time we saw anything like this was about 15 years ago. So there has been an increase with bond volatility because of the rise in interest rates. As it relates to economic data, the most recent jobs number is just under 200,000. Unemployment rate at 3.7, an hourly rate of salary increase at 0.4. The last read on inflation is 3.1. 0.1% was what was added in the month of November. So again, 3.1 it's going in the right direction, still above where the Fed wants it to be. But still considerably lower than the 9% annualized that is where we were in June of 22. As it relates to the economy, we'll see if this is an outlier, but Q3 GDP annualized at 5.2. Now there's some signs of weaknesses as it relates to the consumer, which drives 70% of the economy. You'll see debt service ratio on households is picking up just under 10% now. And you'll also see delinquencies picking up quite a bit in auto and credit card loans. So you're seeing this after these delinquencies being low, they're starting to pick up. So the consumer is showing some signs of weakness. And that's something to pay close attention to. One of those signs of weakness is that home affordability is its lowest point since the late 80s, due to both not a lot of housing available and high interest rates. Another risk factor to be watching is the total spend. The U.S. government spending 6.4 trillion expected in 2024 and borrowing a full quarter of that. And what's happened with interest rates going up as the service of that debt has increased overall. So something to keep an eye on. This is the net debt. We're going back to kind of where we were, not today, but projected where we were kind of in wartime. So also something to keep a close eye on. So the Fed has raised rates faster than any time in the last 4 decades. Now we're starting to look at, including a Fed decision this week, at the probability of a continued pause and then a move towards decreasing interest rates. So what this shows is the probability of rates being paused, represented by the white, versus the first time easing. So what you'll see as we move into the back half, the summer back half of the year, there starts to be a higher and higher probability that the Fed will ease rates after going from a hiking cycle to a no change cycle and then on to an easing cycle. The average, if we look back historically, amount of time between the last hike to the first cut is 10.5 months. Again, we had the last raise in the summer, so that would kind of connect to the data we just looked at, which looks towards the second half of the year being possibly the first easing of rates. So if we look at returns in the markets following the last interest rate hike, pretty supportive for both stocks and bonds on average. And then one of the interesting things is, despite a good year in the markets, there's been net outflows from stock mutual funds and ETFs so far this year through end of October. And kind of what that means as we start to think about 2024 is after a year where there's been kind of net outflows, these are years after that. So overall, that's pretty supportive for stocks and stock performance going forward. We will be rebalancing in the very near future, and we'll have trade notes out to you very soon to let you know how we're thinking about markets and why we're rebalancing, the changes that we're making and adjusting to portfolios. So you'll see that in the very near future. None of what we've spent a few minutes talking about today is questions at all. Don't hesitate to call us. We wish you and your families a very Merry Christmas and a Happy New Year. And until we see you again, we hope that you all stay well and take care.